All right, here's the bottom line. In 1720, a government-backed financial scheme just spiraled into this speculative mania. And it was so vast, it ended up financially wounding one of the greatest scientific minds in history, Sir Isaac Newton. Welcome to the MoniLytics channel, where money meets research. All right, let's get right into it. Today, we're going to be breaking down one of the most just infamous financial collapses in history, the South Sea Bubble of 1720. It's a crazy story of greed, innovation, and, well, a scam so big it managed to trap the entire British nation, including its most brilliant mind. And this quote, it's attributed to Newton himself right after the crash. And it just perfectly captures the heart of our story. This isn't just about making a bad investment. It's about that moment when this collective belief, this kind of social madness, completely defied the laws of financial gravity. To really get a sense of the sheer scale of this madness, just look at this number, £1,000. Now, that was the peak price of a single share in the South Sea Company in August of 1720. And get this, just 8 months earlier, that same share was trading for around £128. So you have to ask, how on earth did this happen? Well, the story starts where a lot of financial crises do, with the government. See, Britain had just come out of the very expensive War of the Spanish Succession. And sure, the nation was victorious, but it was also just drowning in debt. I mean, we're talking about a fiscal crisis of absolutely monumental proportions. So the government was staring down a national debt of nearly £31 million. And look, this wasn't just some number on a ledger. It was a crushing weight on the whole British economy. It was made up of all these high-interest IOUs and unpaid bills to military suppliers. They needed a fix, and they needed one fast. And that's exactly where the South Sea Company steps onto the scene. They go to Parliament with this incredibly audacious proposal. They said, hey, we'll take over most of the national debt. So the government's creditors, they wouldn't be owed money by the Crown anymore. Instead, they'd be given stock in the South Sea Company. This kind of move is called a debt for equity swap. Now, it sounds complex, but the idea is actually pretty simple. You just term your lenders into owners. For the government, this looked like a miracle solution. But for the South Sea Company, well, this was the beginning of a really elaborate and self-reinforcing scheme. Okay, now what's really fascinating here is how the company actually planned to make its money. Normally, right, a stock's price is driven by a company's real-world success, its assets, its profits. But the South Sea Company's monopoly on trade to South America, it was largely unprofitable. The real business was the stock itself. The whole plan was to engineer a rise in the price. That way, they could cover the government's debt with fewer shares, which would leave them with this massive surplus of stock to sell to a frenzied public for pure profit. So think about it. The company's value was based on nothing but the rising value of its own shares. And this crazy scheme worked maybe a little too well. As South Sea stock started its meteoric rise, this wave of just speculative hysteria washed over London's financial district, Exchange Alley. It really seemed like everyone, from the nobility all the way down to the footmen, was getting rich overnight. And that created this intense social pressure, this fear that if you weren't buying, you were an absolute fool. And this, of course, sparked a gold rush of new companies, all promising these unbelievable returns. And this just brilliantly illustrates the absurdity of it all. These are just a few of the hundreds of so-called bubble companies that popped up. People were literally throwing money at ventures for trading in hair, for building a wheel of perpetual motion, and even one that promised to extract sunshine from vegetables. I mean, rationality had completely left the building. This was the absolute peak, the most infamous prospectus of the whole era. It was, for all intents and purposes, a blank check company. The promoter, he opened his office for subscriptions in the morning, and by the afternoon, he'd collected £2,000 in deposits. And then, poof, he promptly vanished and was never heard from again. But here's the thing. Was this famous story even true? It's really important to apply some modern analysis here. A lot of historians now believe this whole tale might have been more of an urban legend, a satirical invention to capture the madness of the times, rather than a documented fraud. The story itself kind of became part of the bubble's mythology. So the crucial point is, this wasn't just some abstract market phenomenon, it was deeply human. And to really understand that, we need to zoom in on one person, Sir Isaac Newton. Yeah, the man who discovered gravity was about to get pulled in by the powerful and totally irrational force of the market. So let's walk through his timeline and see how this all unfolded. Newton was actually an early and pretty savvy investor. In April, he sold his shares and walked away with a very nice profit. But then, he did what so many of us do. He kept watching. And as the stock just surged through May and June, and he watched his friends get rich, he was completely overcome by FOMO, the fear of missing out. He jumped back in, investing nearly his entire fortune right as the bubble was reaching its most fragile point. This was his initial profit, £7,000. I mean, that's a very handsome return, and it proves his initial analysis was totally sound. He'd identified the bubble early and seemingly escaped its pull. But this is the final tally. A loss of £20,000, a completely devastating sum, equivalent to millions and millions today. By giving into emotion and jumping back into the market, he didn't just wipe out his initial gains. He lost a huge portion of his personal fortune. And Newton's story, sadly, was just one of thousands. In September of 1720, the bubble finally inevitably burst. Panic replaced mania, and fortunes were just erased overnight. The public, of course, demanded retribution. Company directors had their estates confiscated, and politicians who took bribes were disgraced. The entire nation was in a state of shock. This chart really says it all, doesn't it? From £128 in January, soaring to £1,000 in August, and then crashing all the way back down to $124 by December. It's a perfect, devastating round trip that just laid bare the completely speculative nature of the entire enterprise. So why does this 300-year-old story still matter so much? Well, because these patterns just keep repeating. The South Sea bubble has some really clear parallels to the dot-com bust of the late 90s. And those absurd, spurious companies, they're strikingly similar to the modern blank check companies we know as SPACs. And all this, it highlights a key concept in behavioral economics, something called synchronization risk. Basically, it's a game of chicken. Even rational investors will ride a bubble because they have no idea when everyone else is going to get out. They're all just hoping to sell to a greater fool right before the whole thing crashes. Which, of course, leaves us with this final question. The South Sea bubble shows us that markets aren't just driven by numbers and fundamentals, not at all. They're driven by stories, by emotions, and by belief. And when that belief becomes completely detached from reality, well, even a mind as brilliant as Isaac Newton's can be swept away in the madness of the crowd. If you found this research valuable, please like the video, subscribe to MoniLytics, and check out the affiliate links in the description to support the channel. And stay tuned for our next deep dive, where we'll be shifting our focus to why a single flower cost more than a house, the first great bubble.